So I hope everybody's got coffee. Try and get you through before lunch. So, yes, vote for me, President of the world. So I'm joined by the amazing Gary and the amazing Greta. We're going to be talking about tax, which either you find really boring, or it fills you full of horror, or you think, why do I need to bother about it? And hopefully we'll explain some of that. So this was originally introduced by Gary, and the idea is that tax systems across the world are designed to cause enough pain that they're extracting tax from you, but not enough pain that you start screaming. And we are sort of doing a bit of observing yesterday, and the word tax was used 102 times during the various presentations. And that doesn't come anywhere close to the amount of times that the words risk, experience, and consequences were used. So we've basically already been talking about tax, which is all about risk and consequences and the need to have experience in dealing with it. One of the other things that was mentioned by Oliver Stone was want versus need. And aircraft owners want a business jet. They don't necessarily need a business jet. Well, from our observations, aircraft owners want to pay no tax, but they really need tax advice. And there are some emotions that go into that. And we talked about emotions yesterday, and that I've saved up all of my money, I'm going to buy this aircraft, it is my reward. And I was thinking about 3 o'clock this morning, for some reason, one of our clients who, when he came to us, he's a very successful man. He'd worked very, very hard, been very diligent, was buying his first business jet, and he proudly presented to us all of his tax returns. He'd paid all his tax ever. It was neatly wrapped up. But he felt entitled now to not pay any tax on his business jet. This was his reward. And you say, but it doesn't quite work like that. Advisors. When we talk about advisors, and yesterday we talked about advisors and where their incentive is. And often our clients have made their money not in the business aviation world. They're in just about every other industry. They've worked very hard. They're very savvy in those industries. And they want to buy their business jet, and they're paying lots of money for all of their advisors, and they kind of anticipate that the advisors are going to have their client's best interest at heart. Often that's not true. Sometimes it's true. Hopefully it's true. There's different incentives. We're all in business. We all want to make money. But it is a be aware. If the advisor on a part of a transaction only has one product to sell, be aware, because they're only going to sell that one product. They're not going to tell you to look elsewhere. Managing expectations. A lot of us in the room are only involved at one end of a transaction. We're not involved throughout the entire lifetime of the aircraft. Tax takes time. It might be some things you can get over and done with very, very quickly, but a lot of it has to do with governments and systems within governments, and that doesn't work to business aviation timescales. So if you're introducing tax as a concept 80% of the way through the sale of the aircraft, you're probably looking at it at the wrong time. We touched upon this yesterday. The LOI, really you should already be thinking about tax, about the physical location of the aircraft, where delivery is going to take place. One thing, so I'm a lawyer by trade. We often get told with legal opinions is, well, it's just the same thing you've always done. Why am I having to pay so much money for this? Just replicate what happened on the last deal. Tax, it's exactly the same. My friend has an aeroplane. Why can't we just replicate? Every single one is different. And if you try to template the tax advice, it's all going to go horribly wrong. Gary was saying when I mentioned this earlier, he hasn't heard this word in a while. Honesty. You need to get your client to disclose and be honest about how they're going to use the aircraft, where necessary parts of their empire is, and disclose those for the tax advice to be relevant and applicable to their situation. Because sometimes they forget that they've got a holiday home in Bordeaux. Sometimes they don't think it's relevant to say that their children who they visit on a regular basis are actually at a university and have property which they own on their behalf in a certain jurisdiction, and that can all impact the picture. So before we move on, one of the things that I think is important to say is who tax is relevant for in the transaction. The buyer and the seller is obvious, but who else? The operator. If that aircraft is grounded, there is a problem. What does the operator say? How do they know what to say? The financier. If it all goes wrong, the loan-to-value ratio is just shot. The broker, equally as important. The broker wants the transaction over and done with comfortably. This comes in at the last minute, and it can completely derail the entire thing. The same for lawyers. So our mission today: aircraft, when they cross borders, they create the potential for a tax consequence. So you need to think about it every single time an aircraft moves across a border, there is going to be a consequence. Getting tax early, we will repeat this very frequently during this presentation. Getting it wrong not only is expensive, it can kill the deal, and it can be massive reputational damage for all of those involved. And when you're choosing your advisor, make sure they've got knowledge and they've got experience, and they're actually qualified to do what they say they're going to do. Because if it all goes horribly wrong, you probably want to sue them, and to sue them, you probably want to make sure that they had the relevant experience, that you didn't just ask the barman what the tax advice was. In the agenda that Oscar sent over, it said the tax universe. And we thought, well, that's going to take a few weeks to try and get through. So we're just going to narrow this presentation down to a few specific things. UK and EU customs implications, the same on value-added tax, and then in the US, sales tax. We're not going to be talking about other forms of taxes, so benefit in kind, corporation tax, federal taxes, local taxes. We're also not going to talk, I've forgotten, flying rights and cabotage and so forth. Specifically, we're going to be talking about the US, the UK, and the EU, which looks simple enough, but I'm going to hand over to Gary and Greta to explain why that isn't quite as simple as it seems.
Thanks very much. Right, so in the United States, we have 50 different states, and we have maybe 10,000 different taxing jurisdictions. Each gets its own say, and they don't agree with each other. And so it's quite the cobweb. It looks like your tube, trying to figure out where to go, how to manage these various aspects. There's really no controlling overarching principle. And also, as I've learned recent weeks, there's quite a disconnect in the US compared to EU, UK, regarding customs and importation, the significance of that to us in the US comparatively.
Oh, sorry, thank you. Okay, the European area, or the EU, as we all know, the UK left the EU, so the EU no longer includes the UK. There were 28 member states of the EU, there are now only 27. I would point out that this does not include, and sometimes people forget this, not only the UK and of course Northern Ireland, Iceland, Greenland, Switzerland, for example. None of these places are part of the EU, even if they're in the immediate area. There are different actual territories. I'm not going to go into this in any detail, don't worry, but there is a customs territory which includes certain areas. Then there's a VAT area which includes certain areas. So pre-Brexit, for example, Jersey and Guernsey were in the EU customs territory but not in the VAT territory. So that's why people used to take aircraft to Guernsey, for example, to close a transaction there, because there wouldn't be EU VAT on the sale. There is also an excise territory, but I'm definitely not going to bore you with that. I'm just explaining that there are different borders depending on all the different historical scenarios.
Thank you. So, Greta, you're going to go up first and sort of talk us through what the VAT and customs systems in the UK and the EU look like.
Okay, actually I'm going to stand up. It feels right somehow. Okay, although we're talking about transactions here, we thought it would be useful to take a bit of a stand back and explain VAT and customs. And what I'm talking about for the UK is pretty much exactly the same for the EU. When we left the EU, we cut and pasted the customs legislation in exactly the same way. And so far, there's been really very little change, although they're talking about VAT on private schools at the moment. And the reason we're doing this is because quite often, obviously if you don't deal with tax normally, you pick up various bits of information along your day dealing with whatever it is that you do. And it can be quite difficult to join the dots and understand where something is relevant and where it isn't. So for example, quite often I get somebody saying, oh, I've got a client, they're looking at an aircraft, they're resident in the UK. Okay, well that might not be relevant. That's only relevant to one of these particular scenarios here. So we thought if we try and join the dots up and explain how these two disciplines work, it would give you the landscape, if you like. So what are the two disciplines I'm talking about? The first is customs. Customs relates to anything that happens on or across the border. So for example, if you import an aircraft, that is a customs thing. The process of crossing the border is a customs thing and it's managed by the customs people. If you export, ditto, it's something moving across the border. Customs is a very, very old discipline. I've just looked it up. The UK, or England set up their first unified customs system in 1203, apparently. So this is a very long-standing discipline. It consists of customs officers standing at the physical border of the territory, quite often in uniform, managing a system which is all about direction. It's make this customs declaration, fill out this form, use this tariff code or this CPC code, customs procedure code, pay your tax. It's all very specific, factual directive. And when you look at any information from any of the tax authorities, that will be what they say. They don't explain why. They don't explain the purpose of anything. There's no real negotiation about it. That is the way it works. And almost all tax authorities, certainly in the UK and almost all of the EU, customs is a different set of people to VAT to people. And that does matter. I'll explain why. My apologies. I've put VAT down as number 9, and I probably should have put it down as number 3 because I'm going to bring it up in the talk. VAT is a tax that's imposed on sales or supplies of goods and services made in the course or furtherance of taxable business. VAT applies based on, for example, for aircraft transactions, where the asset is sited at the time of transfer of title. So if you've got an aircraft sitting in Biggin Hill, when you sell it, when title transfers, then it's in the UK physically, that tethers it to the UK VAT rules. If the aircraft is in Nice Airport, when the title transfers, then that tethers it to the French VAT rules. And that is where the aircraft is at the point of sale is really crucial to the tax treatment from our perspective. So that happens within the territory, customs happens at the border. If you sell an asset inside the UK, then it's treated as within the scope of UK VAT. If you sell it outside the UK, it would be outside the scope of UK VAT, which means that the UK tax authorities cannot tax it. It might turn up in somebody else's jurisdiction. So, for example, if you sell it in Jersey, it would be outside the scope of UK VAT, it would be outside the scope of EU VAT, but inside the scope of Jersey GST. So these are two very different disciplines. The people who manage VAT are tax inspectors. They don't wear uniforms, they don't carry guns, and And it's a much more sort of, if you ever look at the guidance for VAT, it's guidance, it's narrative, it's explaining why things apply. There's a huge body of case law that works to determine when something is VATable and when it isn't, when a VAT exemption applies and when it doesn't, when zero rating applies. So it's a very narrative type thing. And these two disciplines run side by side, basically like two train tracks. VAT people don't really know about customs. Customs people don't know anything about VAT. Most of the time that doesn't matter, except for the occasions where the two overlap, and then it can become a problem. I should also point out, and full disclosure, I had to look this up, there are apparently 175 countries around the globe who have a VAT tax system. Sometimes it's called VAT, value-added tax, sometimes it's called GST or goods and services tax. But they all operate on the same principles. Clearly there will be local quirks, local legislative different backgrounds, and things that vary how it operates. But in essence, a lot of what I'm telling you now for the UK and the EU would apply equally, for example, if you import an aircraft into Canada or Switzerland or South Africa. In general, the same issues apply, and you should be asking the same questions. Okay, so talking about the customs side, the first thing to talk about is import. A customs import is when you make a declaration to the customs that you are bringing an asset into the territory. So you have to use the correct codes, you make a formal declaration. At that point, also, you have to account for taxes and duties as the asset crosses the border. For civilian registered aircraft, there is no customs duty, but there is something called import VAT. An import VAT is always charged at the same rate as the internal VAT rates. So, for example, the internal standard rate of VAT in the UK is 20%. In the EU, it varies from 17 to 27%, but you'll pay exactly the same rate at the border as you would if you're selling something in the UK. I think because there's a lot of confusion about import VAT, it's worth explaining what it's for. Import VAT is really just a levelling tax. There is no sale of goods and services like you would have on an ordinary VAT transaction. It is literally just something moving across the border. And the purpose of it is to ensure that everything that flies around the UK has had the same tax treatment. So, for example, if I'm a UK aircraft manufacturer and I sell an aircraft to Heather, who is a UK person, and I'm running out of time.
5 minutes.
Okay, I'll speed it up. But this bit is really important, and this is a huge difference with the US, by the way. If I sell an asset to Heather and the asset is in the UK, then I'm going to charge her UK VAT at 20% unless there's an exemption that applies. Say Heather goes to Gary and asks, Gary is a US aircraft manufacturer. Gary, if she buys an aircraft from Gary in the US to fly it away, and if that doesn't have US taxes because it's an export, she could potentially just bring that to the UK and she would have a tax-free aircraft. So who's she going to buy the aircraft from? Me, who's going to charge her 20%, or Gary, who's not? So import VAT is a levelling tax. And there are a whole bundle of issues around, if you have to pay import VAT, can you reclaim it? Who can reclaim it? A lot of EU member states and the UK at the moment insist that only the owner of the aircraft can reclaim import VAT. So if you have title to an aircraft outside the territory, you might need to think about restructuring that if you're going to have to pay import VAT at the border. There are no other taxes at import, by the way. And then you've got export. Two types of export. Again, the two systems running in parallel. A customs export, you do the same as you do on the way in. You make a declaration to customs, you give them the correct codes. If you're exporting, I don't know, halon gas or specific medical products, you get a license. And then there is also VAT export, which is a special zero-rated treatment for transactions that are being exported from the country. And the reason is that tax authorities want you to export things. They want you to sell to other countries. It helps with our balance of trade. Almost all of the VAT systems I've ever come across have a zero rating for VAT exports. The really important point about that is there is only one zero rating treatment. If I sell to Heather in the UK and she then sells to Gary as an export, it can only zero rate on the movement where the aircraft leaves. So back-to-backs do not get zero-rated treatment for VAT exports. And then you've got return goods relief. Once you've imported an aircraft into the UK or the EU, you've made your declaration to customs, you've paid your import VAT, either at the standard rate or exempt if it's a qualifying aircraft. You don't want to have to keep doing it. So if you imagine a commercial aircraft, an airliner aircraft, they leave and return all the time. Each single movement across the border is a deemed export and a deemed import, or a deemed return under the return goods relief. You don't want to have to make a declaration every time you do that. So the return goods relief rules effectively say if you've imported it once, you don't have to do so again, providing it's not out of the territory for more than 3 years, and providing the same person takes it, brings it back as took it out, which is always a really difficult thing to explain in a guidance. But say Heather wants to sell an aircraft to Gary in the US. She sends it out for PPI, and then for whatever reason the deal falls through. She's exported it because she's expecting it to sell outside. Deal falls through, she can still bring it back under the return goods relief without having to re-import it and pay the import tax again and do all of that again. Temporary admission. This is the thing about residence. Temporary admission is like a visitor's pass. It means that people from outside the territory and aircraft from outside the territory can come and visit for a period of time, fly around, spend lots of money, add to the economy, and leave again. So the kind of rules that support temporary admission or that control it are, for example, the aircraft has to be registered outside the territory. So, for example, for the EU, if you've got an aircraft that's registered in San Marino or Monaco, they are inside the customs territory and they cannot use temporary admission. If you can't use temporary admission, you have to import. And if you use temporary admission incorrectly, the tax authorities will retrospectively impose import and ask you for the tax. Thank you very much. The residency is the other key point. It's normally, the aircraft itself has to be visitor, so registered outside, but it also has to be used by somebody who's a visitor. So the normal scheme of things, the key user has to be resident outside the territory. Same rules for the EU and the UK. And that's where all this stuff comes in about, do you have family in the territory? Do you have connections? You know, do you really have residency there? And there are some very, very specific circumstances where you can be resident and use it, mostly to do with employment. How am I doing for time? Okay. And then you've got these two things. These are customs suspense procedures. They sit on the border. They're kind of like, in the old days, there would have been actual physical warehouses, and sometimes they still are. But they're like a Schrodinger's warehouse, if you like. Something has got this far, but has not actually been imported, so it can be physically on the ground in the UK, but not imported, so no import VAT is being paid. Inward processing is specifically for works and maintenance. If you're taking a non-imported aircraft, these are both for non-imported aircraft, into, say, the UK or the EU for works, you bring it into inward processing. And the problem with that is you have to get an authorization in advance for doing so. Some repair facilities have their own authorizations. You ask them, they set it up, you just bring your aircraft in. Some of them don't. Some of them don't have authorizations and don't warn their clients that they need to be aware of it. So if you bring your aircraft into inward processing, the benefits are you don't have to import, you don't have to pay tax on the works being done, and if, say, you need to bring an engine or a windscreen or something like that in, you don't have to pay tax on that because it all goes into inward processing. The works get done and it leaves again. We do have guarantees that are virtual, so we can loop over other people's facilities with their permission. And then you have customs warehouse. Customs warehouse is essentially a storage regime. Exactly the same. The rules for both has to be for non-imported aircraft, and they have to arrive from outside. So it comes from France or Switzerland or whatever, goes straight into one of these. When the UK was part of the EU allows member states to choose to allow taxpayers to have transactions tax-free in one of these two regimes. It's an option and member states can choose. The UK chose Customs Warehouse, and they've kept that once they've left the EU. So you can bring an aircraft into Customs Warehouse, sell it tax-free, which means that there are no tax VAT implications. You don't have to register for VAT. You can sell it as many times as you like, so back-to-backs really work in a Customs Warehouse, and then the end purchaser takes it away again. Some of the EU member states have chosen to use inward processing. For example, in Switzerland, you can sell in inward processing. I'm not aware of anybody that uses both, but this is a completely safe way to sell an aircraft. Nobody has to register for VAT, and there's no tax worry. It's completely allowed for in the legislation. I've run out of time now, haven't I?
Okay, so that is the world of tax and customs in the UK and Europe. By the way, if anybody's got any questions, we'll do a question and answer session at the end, and any quick ones we can do in between, but please do ask. So, Gary, over to you on why tax is so different in the US.
Right. So what I'm going to go over is two parts. One is US customs, and separately US sales tax that applies on aircraft transactions and sales. So with the US customs, any aircraft that's going to be sold in the United States, registered in the United States, it first has to be imported, and that's done through U.S. Department of Homeland Security, Customs, Border Protection Division. And the aircraft specifically has to be designated as imported for sale. The failure to comply with this results is the problem of the buyer. His plane could be grounded if they find out the plane has not been properly imported. There's no VAT, there's no sales tax or tax component to the U.S. Customs process. So the procedure, though, however, it does take a couple of weeks to organize, and it has to be done before the flight of the aircraft from the foreign jurisdiction to the United States, before the first flight, because otherwise, after the inspection, the plane has to leave the inspection facility, fly to a foreign jurisdiction, land, and then come back into the United States. So you don't want to have to go through that process. When the aircraft purchase agreement is being negotiated simultaneously, you really have to be thinking about the importation process, because it does take some time to square away. To effectuate it, you need to hire privately a U.S. Customs broker. And then he will send you an email with a long list of questions and things that he needs. Paperwork. He needs a customs power of attorney. He needs from the buyer certificates of good standing. He needs from the seller copies of aircraft registration, copies of airworthiness certificate. And also, as part of the customs importation process, you need an invoice, a sales invoice. So even though your transaction hasn't completed yet, you may only have one in draft form, or you may not have one at all. You need to generate and create an invoice with a purchase price to provide to the customs broker, so he can include that in his package. You also need to decide on an entry point, and that's something worked out with the customs broker. He may prefer Bangalore, Maine, because that's just a good, easy location to bring his plane in, or he has a good relationship with the customs agent over in Savannah, Georgia. But it's pre-planned out where you're actually going to fly into, and that requires a good bit of coordination between the customs broker, customs border protection agent, and the pilot, because he's going to be there at a certain time, you're going to land at a certain time, he's going to be there, get your paperwork, and pass you through quickly. So then basically you have your first flight, and the end result of that is you get paper, you get an entry summary, and you get a release, and you are now imported, and you can operate, buy, purchase the plane in the United States. So that's customs. Sales tax, separate and apart. United States sales tax, I guess it has similarities to that, but it's sort of a back-end tax. It's a transactional tax on the aircraft based upon the purchase price and the delivery location. United States, it's the buyer's obligation to pay the sales tax. However, it is the seller's obligation to collect and remit the sales tax to the taxing jurisdiction. And if the sales tax goes unpaid, the state has the right to go after either the buyer or the seller for the unpaid tax, plus interest and penalties. In terms of the sales tax, our delivery location is very important because, generally speaking, it's the physical location of the aircraft at the time of delivery is the sales tax rules that apply. There has been conflict if the delivery receipt is held in escrow and delivered in Oklahoma, but the plane is in South Carolina. Where did the transaction happen? Did it happen in Oklahoma? Did it happen in Georgia? Generally speaking, it's usually where the physical aircraft is located that it's the operative rules, but you never know what a different taxing jurisdiction might say to that point, which is why everyone tries to localize all that activity as much as possible. Each state is different regarding sales tax, and the rates are all over the place. It could be 0%, it could be 9.563%, and anywhere in between. Some of our states have no sales tax. Those are considered safe states to close in, like Maine, Montana, New Hampshire, New York, Oregon. Those are good states. We have Connecticut. You can deliver in. It's a no tax state if your plane is over 6,000 pounds, maximum takeoff weight. Delaware has a similar rule if the plane is over 12,500 pounds, maximum takeoff weight. Some of our states are considered low tax states. So if you buy or sell a plane in South Carolina, it's only $500. If you do it in North Carolina, it's $2,500. The rest of our states are taxed, so you'll have to pay sales tax if you close or deliver in the state if an exemption doesn't apply. And then we just have a whole series of exemptions that can apply to an aircraft sale. And the typical ones that apply are, one's called a casual sale exemption, meaning the seller is deemed to be a casual seller. They transact in goods and services on an isolated or an occasional type basis. If they lease an aircraft, they're not an occasional seller. If they sell more than a certain number of goods or plane in a certain year, they're not occasional sellers, so that exemption wouldn't apply. We have something called a sale for resale exemption. That's a buyer exemption. If the buyer is registered as a dealer or a vendor, wholesaler, it's not going to be consuming the plane per se, but it's going to be purchasing it for resale or release, then it's capable of qualifying for sales tax exemption there. If it, before the transaction commences, registers and gets certificated. We have something called a common carrier or commercial carrier exemption. If you're a Part 135 operator, you may be able to qualify for an exemption, or a commercial carrier, that can apply too. That's kind of a miserable exemption. I'm dealing with that right now in California, because you don't know if you qualify for the exemption until a year after your transaction's over. You have to track the flights. More than 50% have to be charter for fair market value rate. Then you have to submit paperwork to California and hope it's okay. So that's difficult. A very friendly exemption that we like is the flyaway exemption, which is basically, even though there's a sales tax in the state, they will allow you to transact in the state, buy a plane, as long as you fly away. Okay, seems simple, except each state defines flyaway differently. In Georgia, they have a flyaway, but it only applies to new aircraft, not used aircraft. I've had arguments with clients about that, and they'll tell me, oh, I have a friend, and he closed in Georgia, and it was fine. I said, okay, great. What's his name? Who's his lawyer? They can fill me in on how to do this. And I never get those names or numbers. Florida is a good state for flyaway, except you got to be a non-resident. You have to leave in 10 days, and you have to submit your paperwork or an exemption claim with Florida, which means you've announced that you've transacted in the state. Hopefully you've done it right. It gives them the opportunity to scrutinize the transaction, which could cause problems if your paperwork wasn't done correctly, or they don't deem you to be a non-resident, which can be a floating concept. California, if you properly remove your non-resident, you're not allowed back in the state for 12 months. And another interesting one is Texas. You have to register the plane in another jurisdiction. You have to provide an exemption certificate to the seller. You have to provide an exemption certificate to the state. You can come back to the state, but no more than 50% of your landings in the first year can be in Texas. So you got to track all that. So it's a double-edged sword on delivering in states like this. Bonus on the flyaway, sometimes you get an extended flyaway exemption. So let's say you deliver in a jurisdiction where you're going to do maintenance or engine repair, painting, some such. They'll give you an additional period of time after completion of that work to leave. Like Colorado, you can have 30 days, or Florida, say, another 20 days. Now, for sales tax, as we've said, the delivery location is very important, but that sometimes causes conflict between the seller and the buyer in terms of delivery location. Seller usually wants to deliver in the inspection facility so they don't have to do any additional aircraft movement because there's a risk to the seller in having to move the plane again. You could find a new mechanical issue that comes up. They might not have pilots available to move the plane out of the inspection facility. The seller might be a lender or financial institution that just took the plane back. It may not have the capacity to actually move and operate the plane. It may never have flown the plane. So all of a sudden, it needs to get insurance and pilots on a plane it never operated for a 20-minute flight from Georgia to South Carolina. Now, the buyer will not close in a jurisdiction that's going to trigger tax, and so this just becomes a point of conflict. Usually, the buyer wins on this, and the seller will just have to figure out a way to manage this. Before they mentioned the letter of intent, in terms of our paperwork, U.S. sales tax, because of the delivery location, is a part of the LOI phase, but it's very challenging to get too deep into it during the LOI because the letters of intent are often drafted by the brokers. They're very short and just a couple of pages. Things are moving very, very quickly. There's not really any time to be doing sales and use tax research or analysis or make a definitive determination as to a delivery location. It's also sensitive time. You don't really want to blow up a deal or hang things up or slow things up debating a delivery location at that phase. But if you can pin down a delivery location more or less, it really simplifies things going forward with the purchase agreement and the closing process. So here's two examples. So example of a delivery location language in a contract, either the LOI or the purchase agreement. I would say this is a pro-seller language. The closing of the transaction shall occur at the location of the inspection facility or another mutually agreeable location within the United States. That's pro-seller language because the seller, it's either going to be the inspection facility, or if the seller doesn't agree to a mutually agreeable location, you're stuck at the inspection facility. It gives a lot of power to the seller. In reverse, the buyer, pro-buyer language would say, the aircraft shall be delivered for closing at the purchaser's discretion in Charleston, South Carolina, or another sales tax-friendly location. That really puts the power with the buyer to say, this is where we're going to close, and the seller sort of has to go along with it. So then, as pertains to sales tax in the aircraft purchase agreement, you get your delivery location language establishing your delivery location. You'll also in the contract have sales tax, indemnification, and defense clauses. The buyer is responsible for sales tax due at closing or after, as sellers are responsible for sales tax due before a transaction. The sales tax indemnification defense clauses makes clear basically who's responsible for what, and if the buyers are supposed to pay a tax and he doesn't, and the state goes after the seller, the buyer is supposed to indemnify the seller for that cost. But it is a contractual obligation, so post-closing enforcement is challenging. So moving forward to the closing procedure, the buyer, if it's in a taxing jurisdiction with exemptions, the buyer may have to provide a sales tax exemption certificate pre-placed with the escrow company. If there's going to be sales tax on closing, which is unusual, that also would be put into escrow. And then the mechanics of it, you need to establish proof of delivery location. That's predominantly done with a few things. One is a delivery receipt, which is a standalone document that says this plane was bought on this date from this person